Welcome back to the channel. Today we've got an exciting clip from Tom Lee, the head of research at Fundstrat and chief investment officer of Fundstrat Capital. He joined CNBC's Squawk on the Street to break down his reaction to Fed Chair Powell's speech at Jackson Hole, market expectations, and a lot more. According to Tom Lee, Dovish Fed just gave a green light for small caps. That's a statement every investor needs to pay attention to right now. In this video, I'll first show you the clip of Tom Lee on CNBC, and then I'll give you my detailed breakdown and reaction to what he said. After that, I'll dive into an in-depth analysis of 2 high-growth stocks you should consider buying right now. If you're only going to watch one video today, make sure this is the one. Watch it all the way to the end. Before we jump in, hit that like button. Let's get 1,000 likes on this one, share it with your friends, leave your thoughts in the comments, and don't forget to subscribe so you don't miss the next important financial and investing update. Alright, let's hear what Tom Lee has to say.
Tom Lee, head of research at Fundstrat, chief investment officer of Fundstrat Capital. Good day to be a bull, like yourself, Tom.
Yes, it is.
How do you process what we just heard?
Well, I think that it's the Fed acknowledging that the risks now are tilted for the labor market to be softening, and they want to head that off, especially because they don't think that tight labor markets are going to necessarily create inflation. That's a very good sign, and I think it means we have a dovish Fed again, and that's kind of a green light for small caps.
Small caps
and for equities.
They are working. Last I looked, small caps were up 3%. So is this what we need to really confirm the sort of broadening that comes and goes in the market?
Yeah, because I think that one of the things we should watch for is what happens to mortgage rates. But mortgage spreads are right now 360 basis points higher than the 10-year. Historically, it's 1.6 percentage points. So you could see a huge drop in mortgage rates. That's going to help housing, helps the financial small caps. And I think already the ISM, which has been below 50 for almost 30 months now, could finally go back above 50, and that's a good sign for industrials.
Although we had a discussion right on the heels of the speech about a little steepening in the curve. Is there a sense that the vigilantes are at least present, if not being necessarily vocal?
Yeah, but we could also be steepening because growth expectations are improving as well. So this could be like what I'd call a bull steepening. I'm not really sure what the fixed income terms are, but I think it's actually a positive sign for growth.
The only real losers today are going to be some of the yielders and some staples. Would you be cautious on those?
That's right. I think that markets have been holding their breath. They've been getting defensive. That's why we've been bleeding for 5 days. And so now I think there's a relief and some capital gets put to work, and it's good for equities and risk assets.
So, all right, we need to make some news here, Tom. Everyone listens to you. We're at record highs now for the S&P and the Dow. How much more can these stocks rally?
I think there's a lot of upside, especially because, once you get an ISM back above 50, it really does argue for a broadening of markets. And I think one of the leaders probably comes from the financial sector. So I think, towards the end of the year, 6,800, 7,000 is possible.
Led by tech still?
Yeah, so I think you still want to play
this week.
Yeah, you want to be long AI and the crypto trade because those have been the market leaders, so the Mag 7, Bitcoin, Ethereum. But the broadening is really the financials, industrials, and small caps.
So you like them all?
Yeah, it's kind of cyclicals, AI and crypto, but not the defensives.
Your crypto calls have been getting a lot of attention lately, especially on Ether.
Yes.
Where we were talking earlier, we were debating whether it's the future of the financial system. A lot of people are thinking, people like you have said that.
Yeah, I think it's a really important moment happening this year with, the Genius Act, really greenlighting stable coins, and then Project Crypto, which is Wall Street moving on to the blockchain. I think it's a lot like 1971 when the US dollar went off the gold standard. That created the innovation of Wall Street because they had to sort of essentially create this synthetic dollar. Wall Street moving on to the blockchain is a bigger moment, and I think that's why Ethereum is essentially having its 1971 moment equivalent.
But a lot of people just see it as wild speculation and froth.
I'd say anytime something goes up, people tend to call it froth. I think they called AI a frothy trade now, but we know it has a lot of legs, and it's been taking place for a couple years. Keep in mind, Ethereum is also the place where when agentic AI comes together, when you have robots and you want proof of human, you want to make sure those commands come from, a verified source. That's all taking place on a smart contract. A lot of it will be Ethereum.
Tom, thank you. We just scratched the surface on that one, but we'll have you back very soon, no doubt. Tom Lee.
Tom started by unpacking the big news from Fed Chair Jay Powell's remarks, which really set the stage for today's market moves. According to Tom, the Fed is acknowledging that the labor market might start softening, which is important because it shows they're thinking ahead. They're essentially saying, we don't see tight labor markets creating inflation pressures, which is a big green light for investors. In other words, Tom sees this as a dovish signal from the Fed, meaning lower rates or more accommodating policy. And that's generally very bullish for equities, especially small caps. And speaking of small caps, Tom pointed out that these stocks were already up around 3% at the time of the interview. This is exactly the kind of broadening we want to see in a healthy rally. He emphasized that when the Fed signals support, capital tends to flow into riskier assets like small caps and cyclical sectors, which benefit from economic growth. One of the interesting points Tom made was around mortgage rates and housing. Right now, mortgage spreads are significantly higher than historical averages, about 360 basis points above the 10-year Treasury versus the typical 1.6 percentage points. If these spreads start dropping, we could see mortgage rates fall, which would be a huge boost for the housing sector, and that in turn helps financials, which are already showing leadership in this market. Tom even tied this to the ISM Manufacturing Index, which has been below 50 for almost 30 months. If it moves above 50, that signals expansion and is a strong positive for industrials and cyclical sectors. He also touched on the slight steepening in the yield curve, which some may read as a warning signal from bond market vigilantes. But Tom suggests it's more likely a reflection of improving growth expectations, and he frames this as a positive sign. In other words, the market isn't panicking, it's reacting to the possibility that growth is returning, which could sustain the rally in equities. On the flip side, defensive sectors like staples and high-yield dividend stocks may underperform in this environment. Markets had been holding their breath, according to Tom, over the previous 5 days, as investors got defensive. Now, with some relief and fresh capital coming in, risk assets are back in favor. So how much further can stocks rally? Tom believes there's a lot of upside, especially if the ISM index moves back above 50. He highlighted financials, industrials, and small caps as the key beneficiaries of this broadening trend. Technology and crypto still remain market leaders, and Tom advises staying long in these areas. Specifically, he mentions the Mag 7 tech stocks, which include the big tech leaders, as well as Bitcoin and Ethereum in the crypto space. He frames this as a cyclical rotation into growth and risk assets, moving away from defensives. So if you're thinking about positioning for the next phase of the market, this is where Tom sees the opportunity. Now this is where it gets really interesting. Tom's take on crypto isn't just about price speculation. He ties the current momentum in Ethereum to a bigger structural shift in the financial system, with regulatory developments like the Genius Act, which legitimizes stablecoins and crypto for Wall Street. He compares this moment to 1971, when the US went off the gold standard. Just like back then, innovation was, forced to find a new path, and today Ethereum is playing a similar role by becoming the platform for blockchain-based finance. Tom argues that what some people call froth in crypto is really just excitement about this structural shift. Ethereum in particular is set up to be the backbone for things like smart contracts and agentic AI, which require verification and proof of human signals on the blockchain. So it's not just speculation. It's the infrastructure for the future of finance. So to summarize Tom Lee's interview, the Fed is signaling a dovish stance, which is bullish for equities, especially small caps and cyclical sectors. Financials, industrials, and small caps are poised to benefit if the ISM moves above 50 and mortgage rates drop. Defensive sectors may underperform as capital rotates back into growth and risk assets. Technology and crypto remain key leaders, with Ethereum positioned as a foundational platform for the future financial system, not just a speculative asset. In short, Tom is very bullish on the market right now, seeing upside potential in both traditional equities and crypto. It's a reminder that understanding policy, growth signals, and sector rotation can be just as important as watching stock charts. Alright, that's my take on Tom Lee's interview. If you enjoyed this breakdown and want more in-depth market analysis like this, hit that like button and subscribe for future videos where we unpack exactly what's moving markets and how you can think about positioning yourself. Are you ready to find the next big winners? What if two market giants are hiding in plain sight? These are companies at the forefront of innovation and industry leadership, a leader in consumer culture, a pioneer in collaborative software, a giant that powers the digital backbone of business. We're talking brand-driven consumer growth, and a platform redefining how software gets built and deployed. Two very different businesses, same explosive potential. Let's dive into Dutch Bros first. Let's talk about our first game changer, Dutch Bros, ticker BROS. Subtitle on screen, Dutch Bros, bros, not your grandmother's coffee company. A high-octane, growth-fueled machine, disguised as a drive-through beverage stand, founded in 1992 in Grants Pass, Oregon, synonymous with energy, positivity, and speed. They sell not just coffee but an experience, a community. Coffee, customized energy drinks, teas, smoothies, proprietary cold brew. People lining up around the block. Their target demographic is youth, the future, and they've captured it. Their model, small footprint, prefabricated drive-through units, rapid capital-efficient expansion, quick setup, low overhead, fast rollout. Each new store adds directly to top-line revenue and earnings potential. Operational innovations, employees take orders down the line, slashing wait times. Higher throughput means higher sales per store. Unit economics are strong, profitable stores that scale. Staff culture, Broastas, create die-hard fans. Merch, social engagement, and user-generated content amplify growth. Emotional connection builds a durable competitive advantage. Recent quarters show impressive revenue growth driven by new openings and solid same-store sales. A long runway, management targets thousands of stores in the long term. West Coast stronghold today, national dominance tomorrow. They've been volatile since IPO, typical for high-growth names. That volatility can create attractive entry points for long-term investors. If you can hold the vision, the payoff can be large. Dutch Bros coffee chain currently holds a market cap of $8.28 billion. With an expected revenue of $1.28 billion in 2024 and an EPS of 47 cents. What's particularly interesting is that Dutch Bros recently crossed above its 200-day moving average, which is often seen as a signal of a potential long-term bullish trend. The company delivered a strong second-quarter earnings report, with revenue rising to $415.8 million. That's a 28% increase compared to last year. Adjusted earnings per share came in at 26 cents, beating analyst expectations, which has analysts projecting a potential stock price surge of roughly 26.7%. Following these strong results and a raised fiscal year revenue forecast, market sentiment has turned noticeably positive, with the stock closing higher in recent sessions. From a financial standpoint, Dutch Bros maintains a profit margin of 6.63% and a return on equity of 6.56%, indicating solid operational efficiency. The company also has a healthy debt-to-equity ratio of 0.41, providing room for growth without taking on excessive leverage. While short-term volatility remains, the combination of strong earnings, operational efficiency, and optimistic analyst projections suggest a favorable outlook for Dutch Bros as it continues to expand and maintain investor confidence. Let's dig deeper into what makes Dutch Bros a phenom. It all starts with people, a culture that promotes from within and creates ownership. They give employees a clear path to franchise ownership, powerful for retention. That loyalty translates to consistent, friendly customer experiences. Happy employees mean happy customers. Speed is the second pillar. Convenience is king. Going down the line reduces window time and boosts throughput. More customers per hour, higher sales per store. The vibe, the third pillar, is everything. Music, energy, customization. It's a ritual, not a transaction. That sense of belonging fuels repeat visits and free marketing. People, speed, vibe, combined, they create a flywheel. Repeat visits, word of mouth, social buzz, self-reinforcing growth. That leads to cash flows that fund expansion and culture programs. Competitors can copy menu or locations. They can't easily copy culture. Brand loyalty becomes a durable moat. That moat translates to predictable unit economics. Profits get reinvested in expansion and training. Training preserves culture as they scale. Scalable model, repeatable results. People, speed, vibe, the secret sauce. Qualitative factors that spreadsheets may miss. Next, why Bros is a screaming buy right now. We've established Dutch Bros is fantastic, but why buy it now? The answer sits at the intersection of growth, valuation, and market sentiment. They're in the sweet spot, proven concept with massive runway. A long-term target of thousands of locations. Every store drives top and bottom line. Scale plus efficiency leads to margin expansion. That creates predictable earnings power over the next 5 years. Short-term market sentiment has been choppy, creating an entry point. Post-IPO volatility pushed the stock lower from hype-driven levels. That's a gift. Premium growth at a non-premium price. Unit economics are strong. Great cash flow per store. Management is executing expansion and controlling costs. Culture remains intact, a key differentiator as they scale. Convenient indulgences are resilient through cycles. Loyalty and customization keep customers coming back. Focus on the next 5 years, not the next quarter. Mr. Market is short-sighted, worried about temporary headwinds. Meanwhile, secular tailwinds keep pushing this business forward. This is a probability, not just a possibility. Buying 𝗗𝗏 today is a bet on a proven winner at the start of a national journey. Own a piece of the next great American consumer brand. Alright, let's pause for a moment. We're talking about explosive growth stocks. Exciting stuff. But do you have the foundational knowledge to spot and manage these opportunities? This video is sponsored by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now back to our next explosive stock. You won't want to miss this one. Let's shift to the unseen engine of the tech world. Now for our second powerhouse stock, GitLab, ticker GTLB, a pioneer in DevOps, the platform that streamlines the entire software lifecycle. From tiny startups to Fortune 500s, teams build, secure, and deploy on GitLab. They offer one platform: planning, coding, testing, security, CI/CD, and deployment in a single UI. That eliminates toolchain tax and integration headaches, faster releases, fewer errors, better security. GitLab is a subscription SaaS business. Predictable recurring revenue, open core model, free tier builds user base, upgrades convert to paid enterprise seats, a classic land and expand flywheel, users become advocates inside companies. The moat, a superior all-in-one product and a fanatical open source community. Community contributions accelerate innovation that closed competitors can't match. Frequent releases keep the platform ahead and sticky. Revenue growth has been impressive. Dollar-based net retention north of 120%. Customers not only stick, they expand and pay more. They're still early in enterprise adoption. A huge runway. GTLB's share price is below post-IPO highs. The market punishes unprofitable growth. That creates a disconnect between price and intrinsic value. For long-term investors, that can be a huge opportunity. GitLab is currently trading with a market cap of $7.43 billion and expected revenue of $759.25 million in 2024. The company has an EPS of 11 cents, and while net income is slightly negative at negative $6.33 million, there are some strategic moves that investors are watching closely. On August 6, 2025, GitLab announced a 3-year strategic collaboration with Amazon Web Services. This partnership is designed to strengthen GitLab's offerings in the DevSecOps space, particularly for clients in regulated industries, and could significantly expand its market potential. Analysts see this as a major step forward, especially given the growing demand for AI-driven solutions in software development. Platforms like GitLab, which integrate AI into their workflows, are well positioned to capture additional market share as the industry continues to evolve. GitLab is also set to release its second quarter fiscal year 2026 financial results on September 3, 2025, and these numbers will be closely watched for signs of growth and recovery. Despite these positive developments, the company's stock has faced some challenges this year, with a 22% contraction year-to-date. The competitive landscape is intense, with pressure from larger software players like Microsoft, meaning GitLab must continue to innovate and maintain its edge to succeed long-term. Financially, GitLab's profit margin is currently negative at negative 11.3%, reflecting the ongoing challenge of turning revenue into consistent profits, but total sales of $759.25 million show there is still strong demand for its services. This mix of volatility and strategic progress suggests there could be opportunities for investors, especially if the upcoming financial results confirm that the company is on a recovery trajectory. Overall, GitLab demonstrates resilience through its strategic partnerships and focus on AI-driven solutions. While volatility remains a factor, investors who keep a close eye on competitive dynamics and market trends may find the current environment a potentially attractive entry point. GitLab is integrating AI into DevSecOps, code suggestions, automated security scans. AI will improve productivity, making GitLab even more indispensable. This widens the moat and cements leadership. Superior product, deep moat, massive market, and a discounted valuation you can act on. Buy, hold, and look back in 5 years with a very big smile. We covered 2 incredible companies today: Dutch Bros 𝗗𝗏 and GitLab GTLB. Dutch Bros fueling our mornings. GitLab fueling our digital world. If you're enjoying these stock tips and you're ready to level up your investing skills, I've got something game-changing for you. I've just relaunched my Value Stocks Investing Master Course, designed to teach you the exact principles used by investing legends like Warren Buffett and Benjamin Graham. But this isn't just theory. You'll learn how to spot undervalued companies using real-world metrics, build a high-quality portfolio, and protect your investments no matter what the market throws at you. Whether you're just starting out or want to sharpen your strategy, This course gives you the tools and confidence to grow real, long-term wealth. It's packed with step-by-step lessons, powerful insights, and practical strategies you won't find anywhere else. So if you're serious about investing smarter and building a future you're proud of, click the link in the description and pinned comment to join today. Trust me, your future self will thank you. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the StocksGalore Patreon today and take your investing game to the next level. Our members there get full in-depth analysis on most of these stocks I mentioned here. Head over to patreon.com/StocksGalore and become part of our growing community of smart investors. Link is in the description. Exclusive deep dives, alerts, and a community that thinks long-term. Now, I want to hear from you. Question of the day. Which matters more to you when picking a long-term winner? Revenue growth, visionary leadership, or a massive addressable market? Drop your answer in the comments below. Let's get a great discussion going. And finally, don't forget to show some love. Hit that like button, subscribe, and ring the bell so you don't miss our next investing update. Links for the Value Stocks Investing Master Course and StocksGalore Patreon are in the description and pinned comment. Don't forget to share your thoughts in the comments, and subscribe to the YouTube channel so you don't miss out on the next important financial investing update. Thanks for watching, and I'll see you in the next one. Thanks for watching.